Deep beneath the Kentucky countryside, locked behind 25-inch thick vault doors, protected by granite walls and armed guards, sits 147 million ounces of gold bars. Each one worth over $2,900. Together, they're valued at over $428 billion. This is Fort Knox, America's legendary gold reserve. But here's the question that keeps economists, conspiracy theorists, and even presidents awake at night: what if it all disappeared? What if America actually ran out of gold? Would the dollar collapse? Would our economy crumble? Or, would anything happen at all? Today, we're diving deep into one of the most fascinating what-if scenarios in modern economics. We'll uncover the shocking truth about America's gold reserves, explore what really happened in 1971 that changed everything, and answer the ultimate question: does America's gold even matter anymore? Stick around, because the answers might surprise you. The fortress that holds America's treasure. Let's start with the facts. Fort Knox isn't just a military base, it's home to the United States Bullion Depository, one of the most secure facilities on planet Earth. Built in 1936 at a cost of $560,000, it required 16,000 cubic feet of granite, 4,200 cubic yards of concrete, 750 tons of reinforcing steel, and a vault door that weighs 20 tons. No single person knows the complete combination to open it. The first gold arrived in January 1937, shipped by U.S. mail from the Philadelphia Mint and New York Assay Office. Can you imagine? Billions of dollars worth of gold, sent through the Postal Service, escorted by armed guards on trains. As of November 2024, Fort Knox holds approximately 147.3 million troy ounces of gold. At current market prices exceeding $2,900 per ounce, we're talking about roughly $428 billion worth of gold. But here's something fascinating: the U.S. government doesn't value this gold at market prices. They still use a statutory price of $42.22 per ounce, a rate that hasn't changed since 1973. By this official accounting, Fort Knox's gold is worth only about $6.2 billion. Now, here's where things get interesting. The last full audit of Fort Knox happened in 1953. Yes, you heard that right, 1953. That's over 70 years ago. In 1974, journalists and congressional members were allowed inside for a brief tour. Then again in 2017, Treasury Secretary Steve Mnuchin visited. But these weren't comprehensive audits. This secrecy has fueled decades of conspiracy theories. Has the gold been secretly sold off? Is it really there? Has it been replaced with gold-plated tungsten bars? Recently, even President Trump and Elon Musk have suggested they want to inspect Fort Knox. Trump stated, "We're going to take a look, and if there's gold there, we'll be very happy." Treasury officials insist annual audits confirm the gold is there, with the most recent verification conducted on September 30, 2024. But the lack of public transparency continues to feed speculation. Fort Knox holds only about half of America's total gold reserves. The complete picture: Fort Knox, 147.3 million ounces, West Point Mint, 56.1 million ounces, Denver Mint, 43.9 million ounces, Federal Reserve Bank of New York, 13.4 million ounces, various displays and working stock, 2.8 million ounces, approximately 261.5 million ounces, about 8,134 metric tons, total. This makes the United States the world's largest holder of gold reserves, followed by Germany, 3,364 metric tons, Italy, and France. But here's the trillion-dollar question: why does America even hold all this gold? To answer that, we need to travel back in time to understand something called the gold standard, and how it shaped the entire modern world. What was the gold standard? For most of human history, gold has been synonymous with wealth. It's scarce, doesn't corrode, and is universally valued. These properties made it the perfect basis for money. Under a gold standard, a country's currency was directly linked to gold. You could literally walk into a bank and exchange your paper dollars for actual gold at a fixed rate. The classical gold standard, 1870s-1914. During this era, major economies pegged their currencies to gold. In the United States, you could exchange $20.67 for 1 ounce of gold. This created international exchange rate stability because all currencies were effectively convertible to gold. Here are some benefits gotten from gold. It prevented governments from printing unlimited money. It created predictable international exchange rates. It limited inflation. It provided automatic balance of payment adjustments. But it did have some throwbacks. It constrained monetary policy during economic crises. It could worsen deflation. It tied economic growth to gold discovery rates. It made it harder to respond to financial panics. The Great Depression and gold. The gold standard faced its greatest test during the Great Depression. Many economists now believe the gold standard actually deepened and prolonged the depression. Here's why. When the economy crashed, people hoarded gold and withdrew deposits from banks. This reduced the money supply, causing deflation and making debts harder to pay. Banks failed. Businesses collapsed. Unemployment soared to 25%. Countries that abandoned the gold standard earlier, like Britain in 1931, recovered faster. Those that clung to it longer suffered more. President Franklin D. Roosevelt took drastic action in 1933. He made private gold ownership illegal. Executive Order 6102. It required citizens to turn in gold coins and certificates. Devalued the dollar by raising the official gold price from $20.67 to $35 per ounce. This gave the government more flexibility to expand the money supply and fight deflation. The Bretton Woods System, 1944 to 1971. After World War II, the global economy was in ruins. In July 1944, representatives from 44 nations met in Bretton Woods, New Hampshire, to create a new international monetary system. The Bretton Woods Agreement established the U.S. dollar as the world's reserve currency. Fixed exchange rates between currencies. Dollar convertibility to gold at $35 per ounce. Only for foreign governments, not private citizens. Creation of the International Monetary Fund, IMF, and World Bank. This was brilliant, for a while. The dollar became as good as gold because it was backed by America's massive gold reserves, which held about 2/3 of the world's monetary gold at the time. Other countries pegged their currencies to the dollar. If France wanted to exchange francs for British pounds, they first converted francs to dollars, then dollars to pounds, with gold serving as the ultimate anchor. The system begins to crack. But there was a fatal flaw in Bretton Woods, famously called the Triffin Dilemma after economist Robert Triffin. To serve as the world's reserve currency, the United States needed to run balance of payment deficits, supplying dollars to the world economy. But continuous deficits eventually meant there were more dollars circulating abroad than America had gold to back them. By the 1960s, this contradiction became critical. On August 13, 1971, President Richard Nixon gathered his top economic advisors at Camp David, the presidential retreat. This wasn't announced publicly. No press. Total secrecy. Present at the meeting, we had the likes of the Treasury Secretary John Connally, Federal Reserve Chairman Arthur Burns, Office of Management and Budget Director George Shultz, Undersecretary for International Monetary Affairs Paul Volcker, later Fed Chairman. Notably absent were Secretary of State William Rogers and National Security Advisor Henry Kissinger. This wasn't a foreign policy meeting, it was an economic emergency. For 3 days, they debated the unthinkable: should the United States abandon the gold standard? The decision was momentous. The Bretton Woods system had structured international finance for 27 years. The dollar's credibility rested on gold convertibility. Allies hadn't been consulted. This would be a unilateral American decision that would reshape the entire world economy. The Sunday night that changed everything. On Sunday evening, August 15, 1971, President Nixon addressed the nation. Americans tuning in expected to hear about Vietnam or domestic policy. Instead, they witnessed economic history. Nixon announced 3 major actions. Closing the gold window. Foreign governments could no longer convert dollars to gold. The link between the dollar and gold was suspended, supposedly temporarily, but it became permanent. 90-day wage and price freeze. To fight inflation, Nixon froze wages and prices across the economy. 10% import surcharge. An extra tariff on all imports to force other countries to revalue their currencies upward. Nixon framed it as necessary to protect American jobs and stop international money speculators from attacking the dollar. His exact words: "The strength of a nation's currency is based on the strength of that nation's economy, and the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators." He promised this would create a new prosperity without war and stabilize the dollar. The Nixon shock. The international community was stunned. The decision had been made unilaterally, without consulting America's allies. European and Japanese leaders felt blindsided. The Bank of Japan intervened massively, buying $1.3 billion in just 2 days, August 16 to 17, trying to prevent the yen from appreciating against the dollar. Within weeks, Japan's foreign exchange reserves skyrocketed to $4 billion. But they couldn't stop the dollar's decline. French Finance Minister Valéry Giscard d'Estaing had long criticized the Bretton Woods system, but even he was shocked by the unilateral nature of the decision. Britain, Germany, and others. Major trading partners scrambled to respond. Some let their currencies float, others tried to maintain fixed rates, creating chaos in currency markets. Treasury Secretary John Connally famously summed up the American position: "The dollar is our currency, but it's your problem." In December 1971, the group of 10 nations met at the Smithsonian Institution in Washington to try salvaging fixed exchange rates. The Smithsonian Agreement devalued the dollar by raising the official gold price to $38 per ounce, later $42.22 in 1973. Other currencies were revalued upward. Tried to maintain fixed but adjustable exchange rates. President Nixon called it the most significant monetary agreement in the history of the world. He was wrong. The Smithsonian Agreement collapsed by 1973. The world moved to floating exchange rates, where currency values are determined by supply and demand in foreign exchange markets. The gold standard was dead. The era of fiat currency had begun. What is fiat currency? Fiat comes from Latin meaning "let it be done," essentially, money by decree. Fiat currency. What it held: not backed by physical commodities, value derived from government declaration and public trust, supply controlled by central banks, can be created or destroyed through monetary policy. The US dollar became the world's reserve currency not because you could exchange it for gold, but because the US had the world's largest economy, deep, liquid financial markets, political and economic stability, legal system protecting property rights, military power to maintain global order. So Nixon closed the gold window temporarily in 1971. But here we are, over 50 years later, and it never reopened. The question is, what actually happened? Did the sky fall? Did civilization collapse? Or did something else happen entirely? There's a fascinating website called "What the Fuck Happened in 1971" that catalogs hundreds of charts showing dramatic economic changes starting around 1971. Let's examine some of these trends. 1. Wages versus productivity. Before 1971, worker productivity and wages moved in tandem. When workers became more productive, they earned more. This made intuitive sense: if you create more value, you get paid more. After 1971, these lines diverged dramatically. Productivity continued rising. Wages stagnated. Where did that extra productivity value go? Increasingly to shareholders and executives rather than workers. The result has been rising income inequality. 2. Housing affordability. Before 1971, a median income earner could save for a house in roughly 2.5 years. Today, it takes over 7 years of median income to afford a median home. Why? Multiple factors, including monetary policy inflating asset prices, deregulation of financial markets, land use restrictions, but undeniably, monetary expansion has inflated real estate prices faster than wages. Now, here's where it gets nuanced. Despite these concerning trends, the post-1971 era has also seen positive developments, massive reduction in global poverty, technological revolutions, computers, internet, mobile phones, increased global trade and living standards, longer life expectancies, greater access to goods and services. The Economist perspective. In a 2012 Chicago Booth poll, 93% of surveyed economists either disagreed or strongly disagreed that returning to a gold standard would improve outcomes for average Americans. Why? Because gold standard rigidity can worsen economic crises by preventing flexible monetary policy responses. The Federal Reserve in the fiat era. Without gold constraints, the Federal Reserve gained powerful tools to manage the economy. Monetary policy tools, setting interest rates, federal funds rate, quantitative easing, buying government bonds and securities, forward guidance, signaling future policy, bank reserve requirements, discount window lending, the Fed's dual mandate, maximum employment, stable prices, 2% inflation target. Here's how it works. When the economy slows, the Fed can lower interest rates to encourage borrowing and spending. When inflation rises, they can raise rates to cool things down. This flexibility helped the Fed respond to the 2008 financial crisis, lowering rates to near zero, buying trillions in assets. The 2020 COVID-19 pandemic, massive monetary and fiscal stimulus. 2022 to 2024 inflation surge, raising rates to combat inflation. The inflation question. Critics argue fiat currency inevitably causes inflation because governments can't resist printing money. Supporters counter that moderate inflation, 2 to 3% annually, is healthy because it encourages spending and investment over hoarding, makes debts easier to repay over time, provides cushion for monetary policy, reduces risk of deflation, which can be economically devastating. The truth? Both perspectives have merit. The post-1971 era has seen moderate inflation most years, occasional spikes, 1970s, early 1980s, 2021 to 2023. Central banks learning to manage fiat systems better over time, greater economic volatility in some ways, but also greater flexibility to respond. So we've seen what happened after 1971. Now let's address the big hypothetical. What if America actually ran out of gold tomorrow? What would happen? Let's imagine someone somehow managed to steal or destroy all 261 million ounces of America's gold reserves. Every ounce from Fort Knox, West Point, Denver, and the Federal Reserve vaults, gone overnight. The immediate effects would be 1. Political crisis. The biggest immediate impact would be political, not economic. Massive scandal and investigations, congressional hearings, potential collapse of trust in government institutions, international embarrassment. 2. Market reaction. Financial markets would likely experience initial panic and volatility. Gold prices would spike globally. Dollar might temporarily weaken on news. Stock market would likely dip on uncertainty. 3. Actual economic impact. Here's the surprising part. Minimal direct economic impact because the dollar isn't backed by gold anymore. Federal Reserve policy doesn't depend on gold reserves. U.S. creditworthiness based on economic strength, not gold. Financial system operates on confidence in institutions, not gold backing. The reality check. America's gold reserves, valued at market prices, are worth about $700 billion. Sounds like a lot, right? Compare this to U.S. GDP, $27 trillion annually. Federal Reserve balance sheet, $7+ trillion. Total U.S. stock market value, $50+ trillion. U.S. national debt, $35+ trillion. Which according to new sources may have been topped up with a whooping $2 trillion extra. The gold reserves represent less than 3% of annual GDP. In the grand scheme of the modern economy, they're symbolically important but economically peripheral. Scenario 2, gradual depletion. What if the U.S. gradually sold off all its gold reserves over time? Why might this happen? To pay down national debt. Fund major infrastructure or social programs. Respond to economic crisis. Follow some countries that have sold reserves. Historical examples. Britain sold much of its gold reserves in 1999 to 2002, the Brown Bottom, named after Chancellor Gordon Brown. Canada sold most of its gold reserves by 2016. Switzerland sold significant gold holdings. What happened to those countries? Their currencies and economies continued functioning normally. The gold sales caused no economic catastrophes. If the U.S. did this, most likely outcome, the economy would continue operating normally because modern economies don't depend on gold reserves for monetary operations. Scenario 3. Loss of confidence. Perhaps the real risk isn't physical gold loss but a loss of confidence in the dollar's reserve currency status. What could trigger this? Massive fiscal irresponsibility, hyperinflation, political instability, rise of alternative reserve currencies. Current reality. Despite decades without gold backing, the dollar remains the world's dominant reserve currency. About 60% of global foreign exchange reserves held in dollars. Most international commodities priced in dollars. Dominant currency for international trade. Most international debt issued in dollars. Alternative theories. Bitcoin and cryptocurrency. Yes, you heard that right. Some argue cryptocurrencies could replace gold and fiat currency with fixed supply, like gold. No government control. Digital portability. Challenges. Extreme volatility. Limited real-world acceptance. Energy-intensive. Lack of regulatory framework. Chinese yuan. Some predict the yuan might challenge dollar dominance, but significant obstacles remain. Capital controls. Less transparent financial system. Less deep and liquid markets. Trust and rule of law concerns. Return to gold standard. Periodically proposed but faces massive practical obstacles. Would require unprecedented international coordination. Limit monetary policy flexibility. Total gold supply insufficient for modern global economy. No country has appetite for the constraints. The ultimate answer. So what happens if America runs out of gold? The honest answer, in practical economic terms, probably not much. The modern global economy doesn't run on gold. It runs on trust in institutions, rule of law, economic productivity, innovation and technology, human capital and education, financial market depth and liquidity, government stability. Gold remains a hedge against uncertainty, a store of value, a reserve asset for extreme emergencies, symbolically important for monetary credibility, but it's no longer the foundation of the monetary system. The real question. Perhaps we're asking the wrong question. Instead of what happens if America runs out of gold, maybe we should ask, what happens if America runs out of the things that truly back the dollar? Economic productivity, innovation, political stability, rule of law, military power, trust in institutions. Those are the real foundations of currency value in the modern world. What we've learned. We've journeyed from the vaults of Fort Knox to the Camp David decision of 1971, from the classical gold standard to the modern fiat currency era. Let's recap the key insights. 1. America's gold is still there despite conspiracy theories. The 147 million ounces at Fort Knox and other facilities remain intact, representing the world's largest gold reserves. 2. The gold standard ended for good reasons while it provided stability. The gold standard's rigidity made economic crises worse and couldn't accommodate the modern global economy. 3. The post-1971 era is complicated. Abandoning gold enabled greater monetary flexibility but also contributed to wage stagnation, asset inflation, and inequality. The trade-offs are real and ongoing. 4. Gold reserves matter, but not how you think. Physical gold no longer backs the dollar, but reserves provide symbolic confidence. Ultimate reserve asset for catastrophic scenarios. Diplomatic and monetary credibility. Psychological anchor for monetary system. 5. If America lost its gold, the immediate economic impact would be limited because modern economies don't depend on gold reserves for day-to-day operations. The political and symbolic impact would be much more significant than the economic impact. The bigger picture, the story of America's gold, is really the story of how we think about money, value, and trust in the modern world. We've moved from money being valuable because it's made of precious metal, to money being valuable because a government says it can be exchanged for precious metal, to money being valuable because we collectively believe it is. This shift horrifies some people. It seems like a house of cards built on nothing. But it's enabled unprecedented economic growth, global trade, and prosperity. The real backing for the dollar isn't gold sitting in Kentucky. It's the depth and liquidity of U.S. financial markets, the stability of American political institutions, the rule of law and property rights, innovation and technological advancement, the accumulated trust built over centuries. Final thoughts. Will we ever return to a gold standard? Almost certainly not. The modern global economy is simply too large and complex to be constrained by the limited supply of a shiny metal. Could the dollar lose its reserve currency status? Possibly, but it would require massive changes in the global economic order, not simply running out of gold. Is the current fiat system perfect? Absolutely not. It enables inflation, encourages government overspending, and contributes to wealth inequality. But it also provides the flexibility needed to manage modern economies. The truth is, money has always been about trust. Whether it's gold coins, paper bills, or digital transfers, money only works if we collectively believe it has value and trust the institutions that manage it. America's gold reserves are a fascinating relic of an earlier monetary era. They're important for historical, symbolic, and reserve purposes. But if they disappeared tomorrow, the dollar wouldn't collapse. Because in the end, America's real treasure isn't locked in Fort Knox. It's the productivity, innovation, and economic dynamism of the American people. That's what truly backs the currency. What do you think? Should America return to the gold standard? Sell its reserves? Keep them locked away? Let me know in the comments below.